All right. I believe we have gone live. This is the Investing Power Hour number 78. I think we're going to keep it as season one forever. We're never going to move on to any sort of season two. We're just going to keep going and going and going until we hit 1,000. But my name is Brett Schafer, and I am joined as always by Ryan Henderson. This is, I should say, Chit Chat Money, investing podcast, talking about anything about stocks. On these episodes, we talk about basically an open-ended discussion on any sort of financial topics, any sort of business topics that come to mind, anything we want to talk about. And it's a very free-flowing discussion. If you're listening to this, we do them live. A few people join, but for those that do, they love asking a lot of questions. They can help spur the conversation themselves. And we go live every Thursday morning or Thursday midday on the East Coast, Thursday morning on the West Coast. And it kind of depends where you're listening around the world. But you can come join us, ask us questions. It's usually 9:30 a.m. Pacific time. But that is all I think I have for the intro. So Ryan, how are you feeling today? It has rained for about 1 week straight here in Seattle. So we got fall very early, and it's not been the best, but at least the markets have been exciting. There's been tons of news this week.
You know what? I kind of find the rain a little refreshing after a summer of pure sun. I don't know. It's kind of exciting to me, but yeah, after about a week, it starts to.
I'm already tired of it.
Yeah, because we're in this for about next 8 months, but
why don't
let's talk markets because no one cares about Seattle weather.
I don't know. Hey, maybe they might. But yeah, why don't you go through one topic unless you have any sort of thing you want to talk about first while I kind of tweet out the links.
Well, government shutdown, markets are down, markets in turmoil.
Yeah.
We'll never recover from this. There has been a ton of news over the last week or so. You got the one that I really want to talk about, which is the FTC lawsuit. Which the FTC lawsuit on Amazon, which seemed a little ridiculous. And there's some really good tidbits from that. But why don't we start with Match Group's new Tinder Select tier?
Biggest news of the month, I'd say.
For Match Group shareholders, certainly. Yeah, Match Group launched this new tier for Tinder called Tinder Select. It's a nice little measly $500 a month. The benefits aren't really that exciting, to be honest. The whole, I think, appeal here is that you are in an exclusive group, essentially. So they're not accepting everyone. You have to apply to be considered for Tinder Select. And if you're accepted, then you can pay $500 a month. And basically, from what I understand, it's just like the hottest people get accepted. I think it's based on like a likes ratio. Or am I wrong?
No, it's active. No.
Most active?
That would make no sense, Ryan. Come on. The hottest people don't have to pay for anything.
That's fair. I guess it's going to be like 90% men that are paying for this then.
Yeah, of course. As always. Yeah, I mean, it's going to be, frankly, the ones that struggle the most, right? And the ones that are wealthiest. I mean, you're not going to have attractive people on there. It's the ones that said it's the 1% most active, which I think makes a lot of sense. So the people that are on there a lot.
It didn't say the 1% most active. It just said membership spots are limited to less than 1% of users.
Yeah, I thought when I read an article, when I wrote something up on this, it said 1% of like their best users, their top users. So I'd say that's most active. Power users, basically. I
haven't seen anything that says that's what they're going to do. I mean, in the conference calls, they basically said there are people that, I mean, it kind of makes sense. So like there are people that have a much higher propensity to pay or propensity to spend, and you're basically charging them the same as everyone else. That doesn't really make a whole lot of sense. They talked about power users in the conference call, but
yeah. So you're saying, so you're thinking of the people that they're available to talk with, but I'm thinking of the ones that are going to pay. So are you saying
could be, but like, okay, so there's like the select mode, which means you can only see other accounts that have select. My thought here is, why would you want to see 90% other dudes?
Yeah, so I think it's different. The ones that are paying are going to be different than the ones that are you're seeing.
Yeah, but I'm saying there's going to be like a mode where you can only see the people that are paying.
Oh, well, that doesn't seem very valuable.
The thing that I think is probably what people are going to pay for the most here is you can direct message people without matching with them, and you can actually go back to your previous 7 days of likes. So say you came across some account that was just like you felt it was the magical one and you had to message them and you liked them 5 days ago and they hadn't matched with you. And just to be clear, that doesn't necessarily mean like they didn't like you too. They might not have seen your account. Like you might not have been made available to them. They might not have noticed that you like their account, so they just didn't get the chance. If you really wanted to match with them and you were willing to spend $500 to do so, you could apply to Tinder Select. You could go back, check out your likes, send them a direct message without even matching with them. I think there are probably some people that would pay for that. Now, I'm picturing 90% of the users here being really well off, like teens and 20-year-olds that just have way too much money to spend and probably get quite a good allowance from their parents.
Oh yeah, just like mobile gaming or video games in general. Yeah, and since we've been kind of confusing here, here I have a summary of the key points. So $500 a month. And as Ryan mentioned, the key point here is messaging with people they have not matched with, while the quote most sought after users will see their profiles. And then the third point is that Tinder is offering the plan to less than 1% of its users it considers extremely active. So I think we're both right.
Yeah. Matthias H puts in the chat, are they catering to sugar daddies? Probably.
Well, that might be.
Unfortunately, that might be the most common use case. Now you can like opt out of receiving direct messages without matching. So if you're just getting spammed with crap, like you can just opt out of that stuff. The other thing that I think is kind of interesting here is they're like, you will have the option to display the select badge on your profile. Don't you think it's kind of a very weak look to be like, yeah, I pay $500 a month for Tinder? Like no one's gonna want to see that.
Okay, on the one hand, typically you want that they don't broadcast that you're paying, right? Because that shows the weird signaling thing that goes on with dating. You want to show that you're cool, that you're not trying, that you're not trying too hard, that you're trying to, that you need to pay, right? But for this one, Matt H mentioned I don't know how to describe it. The fact that you have the badge that shows you can afford $500 a month could be beneficial. So I think giving that option is nice. And what's interesting here is that I like that they priced it extremely high for their ultra premium tier, because you don't want too many people signing up for this thing. There's not going to be that many people that want to, because of there's only a select few people, but it's going to have extremely high incremental margins. And if you have, so it's $500 a year. So basically on an annualized basis, $6,000 a year. When you sign up for these things, it's usually not on a yearly basis, but people cycle through. That means if they have, and let me make sure I'm doing the math correctly here.
Tinder's probably got like 60 million monthly actives.
Yeah. So if you have
depending on how you measure it,
basically 6,000 annualized times, let's say they get 10,000 people to sign up. That's $60 million. So that's not bad, right?
If they got 1% of their users to pay for Tinder Select, that's probably like, I'm guessing that's 500,000 users.
Yeah, and I would think it would be closer to like 0.2%, but that's still fairly meaningful.
Yeah, I agree.
Okay.
They also did the classic, if you can just get 1%. Everyone, like the whole, like, if they can capture 1% of their market, it's huge. So whatever. But no,
what do you think of it? I guess, yeah, let's talk our opinions.
Well, my classic thing to do is anytime a company that I own announces something, I rationalize the best case scenario. And I think, oh, this could totally work out. And then
strategic partnership. Ooh,
remember,
interesting.
Oh yeah. Remember Tinder coin? Maybe that is the future. Anyway, I do think there's a market out there who, and frankly, it's probably a lot of the creepers, although they do have like certain conditions that have to be met for your profile. You have to have like 5 pictures, you have to have a real bio, and you have to have like activity. I think there are a bunch of people that can pay for this and will pay for this. I don't think it'll be that significant financially. Maybe I'm wrong. I think,
It's pure margin, basically, right?
yeah, Bernard Kim said he's had success with this at Zynga, where allowing your highest end users to pay egregious amounts helped them. And so he's seen the success of it. He says he's excited to try it on Match Group. Its properties, probably just starting with Tinder. The other thing that I potentially like here is it may be helpful to offset some of the really popular people that have gone to things like the League, or what's the other one that's like for really like famous people? You know what I'm talking about?
Raya.
Raya.
Right.
Maybe if you can build this into like the high end, wealthy, exceptional active users, and they can filter it to just select mode, it can replace some of the Rayas and the Leagues of the world. I don't know. It might be helpful, but that's really kind of a small market.
Yeah, I think it's a good plan, but not a game changer and TBD, but they're doing the right thing. All right, let's do another topic. I wanted to talk a presentation on short selling. This is kind of older. It's from Upslope Capital, a great short seller on Twitter, but I thought it was very relevant. And I had a note here that, markets start dropping. So we talk about short selling, but I thought it was really interesting for any listeners. I'm going to share the screen, but it's really, if you're listening, it'll be pretty easy to follow along, but I just want to show these so Ryan can see them as well. The gist of it was that short selling it gets a worse reputation than you think. He has a starter slide here, which basically says, and he has some good pop culture stuff going along with it, where like he has the old quip that everyone says, did you know that shorts have unlimited potential for losses and your gains are capped at 100%? And then he has Jim Chanos saying, I've seen a lot more companies go to zero than infinity, which is definitely right, because no company has ever gone to infinity. And a lot of companies, what is it, like 90%? No, I think it's 60, 70% underperform, something like that. Actually, he has the stat in here.
That's like the first picture I've seen of young Jim Chanos.
I know, whatever the
Just
old
looks so different. That's so funny.
The old 80s Wall Street people with they wear the suspenders, the big ties, the white t-shirt. They would look,
in
that's a good look.
in their high floor office.
Yes, exactly. Okay, so yeah. Oh, actually, here's the slide. So here's the number here. Most stocks are underperform, say, the index, whatever index you want to choose. They use the Russell 3000 here. So 66% underperform the Russell 3000, and 40% of the stocks have negative absolute lifetime returns. And what this means is, for anyone that doesn't know, if you're running a long short strategy, it's not necessarily that your shorts have to go negative, right? It's that they need to underperform the ones that you buy. It's great that if they go down a lot, but it's not necessarily the end of the world as long as they underperform your longs. And again, there's some math there. There's the short interest you have to pay, and then there's the stuff you can earn owning like treasuries on the cash, that you take in, something like that, right? But that's besides the point. He does give some examples here. There's a nice chart, and we don't need to describe the chart for anyone, but here's what they say they like to focus on as short targets. And there's 2 things here. And he has a chart that goes for basically time needed or stress and mental health cost versus odds of being profitable. And they like to focus on the ones that might be the most stressful, but have the highest chances of being profitable over the long term, which are if you can find big time fads and frauds. And he goes through 2 examples, and I'll go through basically. So I guess an example here, for a fad. Actually, was it a fad or a fraud? I don't know. It was Tattooed Chef. And you looked at, okay, so many red flags that added up. And this is why they wanted to target it. One, going after, SPACs. Two, talking about TAM. Three, accounting shadiness, shady promoters liking it and pushing it. A lot of hazy data, writing a fad, which is like, kind of the trendy plant-based food, that type of stuff. Remember that kind of bubble we had with Beyond Meat and stuff like that. And then obviously it was overvalued, related party nonsense. This all added up to be really a easy short, I would say, over the long run, even though it kind of ran up for a while. And then I guess another thing he talks about here, and maybe we can pause after and do a little discussion and maybe continue if Ryan has any thoughts here. And I thought this was a perfect example. I mean, we don't really short at all. So, but we've been kind of in the community that doubted Tesla, right? We've been Tesla doubters for a while, and that's obviously been quite wrong. But he says you don't need to be a hero, which he says, why fight Mike Tyson when you can kick Granny in the shins, which is apparently from Aristides Capital, Chris Brown on short side. I don't know if that is a fake thing or a joke, but if that's real. And basically he said, okay, you can target a company that's going to say they're going to go from zero revenue to 300 million in revenue in 3 years and hit 34% margins, as long as we can figure out a way to file a 10K someday and get this at the money offering going. Or you can fight Mike Tyson, which is mostly self-funding. CEO has legal immunity, investor base will YOLO anything and doesn't care. And the two CEOs were, one, Arcimoto, which is that electric golf cart vehicle, which is apparently the easiest short ever, if those are the numbers there. And the second one was Tesla, which has ruined a lot of people shorting because, of the examples above. So Ryan, maybe I stop there. Any thoughts on that so far on targeting the frauds and the fads for your for short selling?
No, I think this is my first time looking at this, and I really like the presentation because I think a lot of people, when they hear frauds, and Dan McMurtry once said, we don't short frauds because if the one thing you learn about a public fraud is that they're probably pretty good at being a fraud. But I think a lot of people, when they think about frauds, think about the most high profile ones, as opposed to the companies that are just scraping by, have shady accounting, happen to get public because they wanted to use public shareholders to finance their own operations. I think Tattooed Chef is probably a really good example of that. It might not be like the biggest outright fraud, like say an Enron, but there's probably some fraudulent stuff going on, and it kind of fits into that fad trend. I think that's probably a pretty good approach. I like that.
And it's one where the fundamentals don't look even that good. And I think one thing he talks about is wait for the break, because there's going to be a lot of downside once it breaks.
Interesting. The one thing that would concern me about that strategy is, in an environment like a 2020, the frauds tend to have the biggest cults, and you get really easy financing, and sometimes it feels like it can turn a fraud into a real business. But
yeah,
obviously if you're shorting at the end of 2022, it's good. You just kind of don't know how long that irrationally exuberant environment is going to last.
Yeah, that's an interesting point. I think he covers some of that later in the presentation, which maybe we can go through. We do have a comment though from Matt H saying, when Druck says he's probably made no money shorting, does that mean he's just bad at shorting then? Possibly, because you can't be good at everything. He seems to be good at a lot of things, but maybe shorting's not one of them. I think what's interesting is, and again, people have this idea about short selling that you got to buy something and then it has to go to zero. One, and this wasn't true after the great financial crisis for a while, but it is true today. When you short sell something, you get cash in. So you could either buy treasuries, right? Earn 5% on that, or you buy another company. And if the spread on that is, positive, you're going to make money, right? If you buy a company and it performs better than a stock that goes nowhere, you're going to make money. And again, I know we're not experts here, but generally that is true.
Yeah, I think this really kind of opens my mind up to it a little more, because you do hear a lot of narratives of the riskiness associated with it, when there's definitely some ways to kind of contain that risk. The concern is more of the
I'm showing an example of the concern right here, where the Arcimoto stock went to the moon for a little while there.
Yeah, and what's his name? Who's the Australian fund manager?
Hampton, another long short
Hampton.
seller, does
His
stuff.
quote
Yeah.
around it was like shorting in 2020 was like shooting fish in a barrel, but sometimes the fish would shoot back.
Yeah, that's true.
I think that's where it like makes me worry, is the Colts that can get behind some of these stocks can just, even though they have no real viability, they can, if you have promoters like a like what we're seeing there on the screen.
Yeah, it might be a certain ETF manager in front of the Arcimoto car, which is a hilarious, absolutely hilarious sight. But I think here two things with that. One, you probably can't like going too much. I forget the industry term, but basically having too much leverage when using this type of strategy. Can't do that, right? Because you don't. That's a big risk of blowing up. And second, you probably need 30 to 40 positions that are all sized fairly small. But I think the good thing is about that is there are so many of these small, mid-cap, really terrible companies out there that if you have a bigger team, I think it's not the hardest thing to do to find 30 to 40 of these things that are going to really underperform over the long haul.
Yeah, I wish we kind of adopted this approach earlier. I know it's easy to say coming out of 2020, but
what do you think? Are we still? I mean, we're both different, but you think we're still? I feel like I'm still multiple years from able to employ any sort of this strategy with any confidence. Like I still need to learn a lot.
Yeah, I just haven't really dedicated a lot of time to learning it, to be honest. We've been running a long only fund, and so the focus has constantly been what works for us on the long side. I think before I put any real money to work on the shorting, yeah, I'm probably a couple of years out.
Yeah, at least. Yeah, I might. Yeah, I might be. That might be something I would do as I get older. But we're still, young, so we're still learning along with all you guys.
And if I'm ever doing it like solo, I don't know if I'd be doing it. Like,
that's right. It takes a lot of time. It takes a lot of
If I'm just putting money in my Roth and wanting to look away for a while, I don't think shorting is going to be my.
Yeah, because it takes a little more time and tracking, I would say. But here, okay, let's keep going on the presentation. So we looked at the one that said like the perfect target, which was Arcimoto during Bubble 2.0. As the presentation says, not a joke. So the backstory was a complete and utter BS qualitative story about these three, it's kind of like these golf cart style electric vehicles that were super niche, and there was near zero chance of financial viability. They only had $7 million in revenue and negative $56 million in EBITDA. It was heavily promoted to retail, and CEO cared a lot about shorts. So the presentation says, check, 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 check. This is the target, right? That we want to go for a short. However, given the pump and dump here, he said, lesson learned, size carefully. I did not manage this one well. I lost a modest amount of money, even though it's basically gone to zero. But he says this is kind of a good lesson, as it really doesn't get harder than this. So that's kind of the downside. Is like, okay, you can target something that's a clear zero, but you actually might not make any money.
Yeah, that makes a lot of sense. That's a really good indicator of how much do management teams worry about shorts.
That's true. That's true. That's a positive and a negative, because sometimes they can really try to, I think, screw you. You've seen that from time to time. All right. And
they can
go ahead.
Make you the enemy that their shareholders rally around.
Yeah. So here's golden rule for fad and fraud shorts. Size and manage your positions to survive. no outsized positions, no shame, stemming bleeding. If you, as needed, walk away from the screen, have patience, wait for the break, which basically means wait for the stock to break and wait for the fraud to break, right? Accept that. You have to accept that even if it's a small, like 70 basis point position, really, really small position, and if it's headed to zero, it is going to be a strong value add, even if you don't resize it as you go down. Because again, this, as the short goes down, it becomes a smaller position in your portfolio. A lot of people, and this is what the GameStop shorts got in trouble with, tend to add to their short as they go down, right? Kind of pile into your position, hopefully get more gains. But what he says here is you want to make fads and frauds boring. Fish in the right pond, which is there's never a shortage of lousy stocks. Look for a pileup of red flags and look for the granny versus the Tyson. So don't go after Elon Musk, who has a lot of power out there. And then you want to size smaller than you think. So lots of tiny positions, which helps you keep your sanity. All right. I don't know if we want to do any more there.
If the CEO has more than 50 million followers on Twitter, don't go after it.
Yeah, that's true.
What were some of the most clear shorts? I know this is kind of obvious now, but where were a pileup of red flags? Do you remember any companies throughout 2020, 2021 where we're like, oh my gosh, there's so many?
RC Moto. I mean, the one that we knew for a fact that we covered as a not so deep dive was App Harvest. I mean, we were like, okay, this is the easiest one. But again,
well, we talked to that friend who said he lived near him and was throwing these massive parties every night.
Yeah. And here we have a comment from Andrew from Capital Mindset said, I know some YouTubers who are unironically super long RC Moto. In that presentation, Upslope says that that's actually an indicator that he looks for. Promoters on Twitter, promoters on YouTube that are very, and it's different than say someone like us who is trying to discuss something. It's like they're literally promoting the stock. That is an indicator that this is a company that he needs to look at as a potential short. And then Andrew also was just talking to one of my friends who works at a long short fund and says shorting is easier. Literally had this conversation with him. And maybe outside, and the last comment he has here, and maybe you can talk about this, Ryan, too, and we can have a discussion here, is outside of the ZERP era, it's going to be a lot better for shorting going forward.
Yeah, I think that's probably right. I want to go back to some of the companies we were thinking about because there was also, I remember throughout 2020 and 2021, having our podcast, I would get messages from third parties that were like ads. It was like, will you talk about our stock? You're not selling, you don't want to advertise your product. You want us to advertise your stock. I guess that is your product. The other one I was thinking of was it carparts.com? What was honestly a red flag was when CEOs engaged with our podcasts, when they'd listen and be like, no, this stuff is wrong. I'm like, why are you, who cares? If you're listening to us and you're like, no one listened to them, they can't be right. It's like, dude, just run your business. Who gives a crap what we say?
Yeah. And then another part on the media stuff is that he said another red flag is when a CEO would go on the podcast circuit, which I got to say, hey, I don't mind that, but it can be a red flag. I'd say potentially if they're constantly going around, especially the more promotional type podcast, right? That could be one red flag. But
no, is that us?
I don't know. But I think honestly, if someone wants to come on our show and they reach out to us to do that, that's a red flag. But we usually have to reach out to them if we're going to get a CEO on our show.
We'll have him on the show, but it's a red flag.
Yeah. And here's what he said though in the presentation. I have to sneeze, so that's why I'm looking like this. Sorry, listeners. I almost had to sneeze there. He says you can't have one. You have to. The red flags have to add up. You got to have 6 or 7, hopefully as many as possible.
Yeah, Tattooed Chef was a big one. Pretty much all the Chamath smacks were just a walking red flag.
Yeah.
The appealing to the heartstrings is a big one. What was it? Virgin Galactic the stuff where it's like, we're not going to give you returns, but it's your investment is for the good of humanity. App
Yeah.
Harvest was the same way. Beyond Meat was, I'm guessing their S1 was like that too, but it was kind of prior to COVID.
Yeah. Nicola.
Nicola. Oh gosh.
Thank you, Julius Caesar. There, he's back. He's back.
Anyway,
Yeah, I think that was a good presentation. I'll put it in the comments here for anyone who wants to check it out because it's not something that's easily findable, but I think that was fun. I don't think anything else there. Do you want to talk FTC?
I want to talk AI first.
Okay, go right ahead. Do it.
So on Monday, I believe it was announced that Amazon was going to invest up to $4 billion in Anthropic. Took me a while to kind of figure out what all Anthropic does, but from what I can understand, very similar to ChatGPT in that they have this AI assistant named Claude,
like Claude Shannon.
The company was actually started by two former OpenAI executives. They have a consumer-facing application, which is, just similar to the ChatGPT most of us think about. And then they also have this AI assistant that they kind of sell to businesses to integrate in their workflows or add on top of whatever. So like they have an integration with Slack where you can add Anthropic AI to your Slack page and you can say like, there's this long thread, summarize it for me, that kind of thing. So they're investing $1.25 billion up front and then a potential additional $2.75 billion if certain conditions are met. $4 billion in total. This is by far the biggest investment acquisition, not really an acquisition, but investment they've ever made for AWS specifically. I mean, they've made big acquisitions and investments for the business overall, Whole Foods, MGM, probably missing some others. There was a lot of, I guess, I don't know, synergies you could call it. To be honest, some of the AWS nitty gritty is over my head. So they were talking about some of the integrations with Amazon Bedrock or AWS Bedrock, which is, from what I understand, kind of this generative AI for developers that helps them with their AWS customer experience. They're also going to use the Inferentia chips, which are like the AI specific chips that Amazon rolled out, which are apparently 30% lower cost. And they're going to use AWS Trainium to train all their AI models. I'm saying stuff that probably doesn't matter to most people. My question to you, what do you think about them lobbing out potentially $4 billion on something? To be honest, we don't understand the synergies here. And it's the biggest sum they've ever done for AWS specifically.
Yeah. Well, I think.
And it's a minority stake, so they don't really have like control over the way the business is going to operate.
Yeah. My thinking is it's maybe not clearly, but I'm worried that it's a bubble. And we'll get to some other stuff here that might be a little more bubbly, specifically with OpenAI. But I like with the cloud providers that there's a margin of safety here because a lot of this money is basically saying, we're going to give you this investment, right? But it's essentially just a partnership to say, okay, you're committed to spending on our cloud platform or whatever you want to describe it, our cloud infrastructure. So a lot of the money is going to flow back to AWS. And I don't think it's a bad move.
Yeah, it's kind of hard to say. I think you almost have to just say Andy Jassy, who ran AWS for the longest time, you kind of have to trust him with this stuff because he's proven it in the past. My only concern is, does it feel like you have to start acquiring or investing in other companies to add certain capabilities? That would kind of concern me.
Yeah.
Other thing that's kind of tangential to this, OpenAI, parent company of ChatGPT, is apparently in talks to raise a secondary round, valuing the company at $80 to $90 billion. That's about
it's about 90 times sales. They're about, I think, at $1 billion in revenue annually right now.
90 times sales, and it's a 2x, 3x, might be triple the valuation that Microsoft invested in them at 8 months ago. So Microsoft's going to beat earnings if this is true, because they're going to have to mark up their stake.
Here's what I was thinking. Yeah.
15 billion.
Yeah, so they do this new round, right? And we'll get to the employee part, which I think is quite telling. But they're gonna get this new stake. Microsoft's gonna have a big unrealized gain. Then that's gonna make sure they beat their earnings per share, which means that Microsoft stock's gonna rise, which is gonna create their momentum, which is gonna get the indexes to buy more, which is gonna just create this self-fulfilling cycle. And yeah, so the indexes are gonna rise, right? To the end of the year, just because of this.
Could be. Very
Yeah.
well could be.
If Apple, I mean, honestly, if Apple and Microsoft beat earnings, for at least a couple of weeks, it drives that momentum. But that's a whole other topic that I actually might not know much about. But there's another important part here that you want to hit, right?
I think a lot of it is, I think I'm remembering this correctly, but I think a lot of it is employees selling stock, not the company issuing, which is maybe telling just in that they're using it as a liquidation event and other people are using it as a buying opportunity. But
yeah, and a 3-year-old company, I mean,
the thing, okay, so I used to just hate on OpenAI, not understand the value proposition. Then this week, Spotify announced this AI for podcast translation where they're going to do kind of this real time. Well, they will, if you upload a podcast, it's a pilot program right now. They're going to be able to translate your voice into a bunch of other languages using OpenAI's technology. Some of those business applications of OpenAI's tech gives me some sense that this could be really valuable. Now, is it 90 times sales valuable? Kind of hard to say, but I'm starting to get a better understanding of how it can be really useful in the real world.
Yeah, and it is. Yeah, it's clearly got a lot of value. What I wonder though is, how hard is it going to be for Google to just replicate this? How hard is it going to be for Amazon AWS services to replicate this? With, again, you talked about them be kind of the third party person to help other people do this. And then also Meta this week, which we're probably not even talking about, launched a bunch of stuff like this. They could probably easily do it. I'm forgetting others. Apple, I guess, seems to drop the ball on this type of stuff. But either way, I wonder how, like, given how expensive it is to do this stuff versus how big the competition is, whether this is going to be an add-on feature similar to the voice assistants that actually don't create much shareholder value, but it's something a lot of these companies have to do. But as I think it's a lot of that, like Spotify's providing a lot of value specifically maybe to us. You could be listening to this in Spanish a year from now. Could be quite interesting. And, there's over 1 billion Spanish speakers in the world. That's a huge value add for a ton of podcasts like ourselves.
Plus, we can hear ourselves speak fluently. That would be nice. There's obviously lots of applications for it. It's nice to see some real ones coming out. I think, though, the chat assistant to me still does not seem very valuable.
Well, if
you really care about your work, it doesn't seem. I mean, cheating on your homework's one thing, but just relying solely on the AI for answering real world problems, like, is it that much better than just researching it and typing out yourself?
Yeah, I agree. And here's, I think, an example that I'm thinking about from an investment perspective. Google came out with Google Translate a while ago. It's gotten way better, right? They have the voice stuff that goes along with it. I'm sure, given that they had the Google Translate stuff, they could do something like this, right? Like OpenAI is doing with the voice translation stuff. But Google does not charge anything for Google Translate because I think they understand that while they could do a little subscription service and probably get 1 million to 3 million people to sign up, maybe even more, it's not what it's about. It's about driving people to their platform so they can sell ads and lock people in with these free services.
Yeah, I think that's enough AI talk for the day. Let's talk antitrust.
Okay, yeah, I have some stuff here. There's a lot of info. We're probably going to miss some things, but I'll try to sum it up. There's so much coverage out there of this, and there's going to keep being coverage because there's going to be the stuff in front of all the lawsuits, and there's lawsuits with Google, Microsoft. I mean, I saw something that was really interesting. Maybe we can try to talk about another week about how Microsoft, under oath, said that they've tried to pitch Apple to be their search default for years, but it's just uneconomical for them because the cost is twice as much as their actual ad revenue, which I think is quite interesting. But that's besides the point. Because this week on Tuesday, The FTC filed a lawsuit against Amazon, joined by 17 other states, accusing Amazon of interlocking anti-competitive actions that it says have inflated prices for consumers, harmed third-party sellers in Amazon's marketplace, and made it nearly impossible for other e-commerce platforms and retailers to compete. Long thesis? No. The lawsuit
I know
claims on
it's that classic. Oh no, there's a monopoly that's winning because it's the low cost provider. That's disgusting. Where?
yeah. Oh,
It's
that's
like,
good. I'm gonna steal that with this quote with that the Always Sunny when with
Mac.
his shirt off when he's fat. Okay, but here are kind of some of the big points from the lawsuit. Again, I'm not going to try to ramble on with everything here, but I think it'll help spur discussion. Some of the lawsuit claims are that one, sellers on Amazon are forced to use Amazon's add-on services. Two, some say Amazon takes as much as 50% of every transaction. I'm sure we don't have any hard evidence of this yet, but I'm sure it'll come out during the trial. Third, the lawsuit alleges that Amazon has increased the number of ads and search results over the years, making sellers feel that the only way potential customers will see their products at all is if they pay for Amazon for ads. Four, Amazon won't let sellers sell for less on other websites while setting an artificially high price floor. Now, most of the things that they allege here seemed a bit weak because it's like, yeah, okay, they can offer these add-on services. That's not anti-competitive because you can go somewhere else. I think the only one that might have some merit is if they basically don't let you go under. If there's evidence of this, I don't think there really is because the evidence that Amazon gives out is that their prices are the lowest out there. But if there is evidence that they set artificially high prices and don't let any, and if someone tries to go lower on another website, they can't, and right, they kick them off. Basically, Amazon, who has about 50% market share, that can make sense. But as well, I don't think that actually, like, it's not strictly antitrust, anti-competitive behavior. It's kind of a weird red line, but it's going to be interesting to see what happens here. I'm curious if you read anything here and what your thoughts are, Ryan.
So on the last one, let's say that you're not allowed to undercut them on price if you're also selling on their platform. Just go sell somewhere else, right?
Yeah.
Like,
well, the thing is,
they are providing you the distribution.
Yeah,
let's
that's
not
true.
forget that that's the value here. Like, they're providing you millions of customers by easily just uploading a couple of products. Secondly, oh no, they're forcing you to use the fastest shipping service in the world.
In the country, but yeah.
In the country. First of all, they're not forcing you to. It's just by far the most valuable. Like, you can do slow weekly shipments if you want. If retailers are complaining that they're being forced to use all of these very helpful value add services, now maybe on the advertising or the promoted listings, you could say it kind of dilutes the experience and it makes it difficult to compete. That's one thing. But like with the shipping, if you want to offer slower times, go for it. They're just offering you the best option. Like, I don't know. Some of this stuff did feel weak. And they were talking about basically how it's anti-competitive that they're being the low cost provider, which isn't that like the opposite?
Yeah.
They talked about how Amazon is lowering margins as an anti-competitive thing, right? Wasn't there that quote in the FTC suit? Let me go find it.
Yeah, okay. Yeah, it's hard because sometimes you kind of just keep like you go through back and forth, like, okay, then this, and this. Like if they sell it this, whatever, like what are they trying to entice people to do? I think what's interesting is that, look, they're gonna try to make an argument that like Amazon for some reason is making it harder for these sellers, and they're like charging 50% of the transaction right on Amazon if they use all of their services. But I don't know how egregious that really is because if you're literally taking the product from wherever it originates and then you're being the demand generation and you're taking it from the origination, like obviously you don't make the product and then you get it to the customer, you're doing all that work. I don't think a 50% cut is out of the question there. Like that's not unfair. I don't think. But
No, I mean they're supplying you most of your sales.
yeah, here's the quote that, and again, I would follow the best follow on this as kind of an expert because it's, again, I'm a bit over my head on all this stuff from all the legal stuff, but I would follow Modest Proposal,
I was
a
about to
pseudonym. Yeah, he's probably the best, or they are.
let me
Okay,
read
here's
this. I
you
think we're
have
about to read the same
the
thing,
same
but
thing. Okay, you go ahead. Yeah.
it says, in effect, Amazon deters rivals from even attempting to compete with Amazon's first-party retail business on price because rivals quickly learned that their price cuts do not result in greater market share or scale, only lower margins.
Yeah, so they're setting the low price. Yeah, here's what I don't understand here is because if they say, and they talk about locking in with Prime, they talk about selling stuff at extremely low prices. If that is true, we should have an antitrust case against Costco because they do a similar thing. They have a subscription service, they have the add-on card product, and they have extremely low prices, and they squeeze suppliers. Costco squeezes suppliers way more than Amazon does. Way more.
I seriously, as a consumer, Amazon has only ever helped. It provides real low-cost items that deliver in a day, sometimes the same day. I don't see, can it really be anti-competitive if it only helps the customer? Once it starts to hurt the customer, then maybe.
That's
But
true. That's true.
That's what Temu's for.
Yeah. Yeah. Here's what, yeah, I think is another interesting point is that it's the claim here, is they want to make it everything okay. They want to make sure company, like the goal of all this stuff in general from a higher level is to make sure companies are not squeezing people and everything is fair in that regard, right? But in this case, they're saying that Amazon is so good at providing value to consumers. And it's almost like we need to make it better for these other companies who aren't making any money. And it's like, yeah, it's a very difficult business. And Amazon is running it at a low margin and they're trying to add on these value add services, but it doesn't make them a monopoly. If
You
what's
do,
it?
you yeah, you don't get to 35% e-commerce share by screwing people. You
Yeah.
get there by providing the most value.
Yeah. I think what's weird about this is that their I think slogan maybe, or motto is probably a better word of focus on the customer first, providing value to the customer. They took that so far, right, by kind of not putting their business partners first. The merchants are the ones that have a tough time because they make them be hyper competitive against each other. They're very competitive against the other businesses out there, Shopify, websites, blah, blah, blah. We all know that. But I would think that's what the FTC wants, right? They want the businesses to be hyper competitive. And yeah, if
The-
Amazon has this market share and just started really raising prices, that wouldn't make sense. I mean, if we're looking at clear-cut antitrust, anti-competitive cases, look at Apple, Alphabet, and Microsoft. Those are the ones that actually do stuff that feels a little anti-competitive. Or that would be clear-cut antitrust cases. I mean, Alphabet and Apple's stuff is, some of that stuff is pretty clear-cut, I think.
Yeah, it is interesting that Lena Khan has basically just had this agenda to, it seems like, tear down big tech or try to raise awareness around monopolistic practices. And it's kind of every company, no matter what. And I read something that she had a thesis paper at Yale that was a flawed thesis paper that was about Amazon's monopoly, and that's how she kind of got the job.
Yeah, that's why she springboarded. Yeah, it was a pretty famous paper. Yeah.
It's funny too that the Wall Street Journal, the day this comes out, posts an article that says hedge funds are making tons of money betting against Lena Khan.
Yeah.
Here's a comment that says where is it? Betting against Lena Khan is a gift from the gods.
Yeah.
It's providing us the ability to get in at lower prices, frankly.
Yeah. I mean, they usually don't go off that much, but
should we have a Mount Rushmore of FTC failures?
No. I think that would be a little bit too cocky. But here's another thing that I would hope any investor thinks about is, okay, say the FTC tries to stop Amazon from the things they think are anti-competitive. Okay, now what? Okay, they could break up AWS. Nothing changes. Those businesses are already essentially separate. Okay, second, they say you can't have the price matching thing that restricts people from selling at lower prices. Take that out. Okay, no one's going to do that, because if you try to sell at a 20% discount to Amazon and you have a Shopify website, your own payment processor, your own shipping processing, your own warehousing, your own inventory management, you cannot sell at a 20% discount to Amazon given their economies of scale and actually make any money. So no one's going to do that.
Isn't this
unless you're Timo and funded by, and it's absurdly or just crazy, which again is not a sustainable business model. So I don't know exactly what changes. Maybe here's one. Maybe the advertising business could be the one that's really under threat here. But if it is, okay, Kroger and Walmart should stop having slotting fees, because it's not really that different. And I could hear an argument there about that being different because it's digital, but
it also makes the experience a little worse for a customer. Like,
yeah,
oh, I got to scroll a little further. Oh,
somewhat. Yeah, I think they're getting. I could hear that argument for sure. Yeah.
The thing I find kind of funny about this is, isn't it in a way kind of roasting like Shopify to say everyone has to sell on Amazon? Like, Shopify's like, well, they don't have to. They can use our websites. And it's like,
we have
no. It's their monopoly. They have to sell on Amazon. It's like, no, people go there because they get the best service.
Yeah. Well, look, you can have complaints about Amazon and stuff like that. It's a giant company. I think there's probably some things, we own the stock and they're not. But you can't
obviously do not optimize for profits.
Yeah, which
we know that as shareholders.
And you can have just because you own a stock doesn't mean you have to put on the blinders and say no, whatever this company and whatever the CEO says is perfect. But I believe, after studying this company, reading both biographies, reading basically a ton of stuff over them over the last 5 years, they are maybe the most misunderstood large company in America, I think, because they get so much hate. And look, they have 1 million warehouse workers, right? Okay. And 6 people peed in a bottle once? Okay. Stuff is going to happen. As Buffett said, they have 500,000 employees across their whole operations. And there's definitely going to be some fraud going on at some of them. You can't control that. As you get bigger, there's going to be some things that go on. But here's 2 things. One, Amazon has invested hundreds of billions of dollars into this country. So I'm thinking more of a political perspective. 2, they provide extreme value to a lot of consumers out there that, one, don't have to drive to places, right? And you don't have to worry about theft in these stores. It's a great value. And then third, they have driven up wages for hourly labor and hourly labor people significantly. I mean, they're the ones that have set the standard and caused Walmart, caused Target, caused these other places to raise their minimum wage to $15 and higher. I mean, they're the ones that have done that.
I've never understood.
I've never understood the hate around that. Yeah.
I've really never understood the hate around Bezos either.
It's because he looks. I think he looks strange and has a weird laugh, and he's just a meme now.
He's one of the most coldly rational people and one of the biggest contributors to advancing kind of modern commerce.
Yeah, if anything, they've done so many dumb projects that their help, the consumer surplus is incredible. I remember one time, this was, I believe, the one when they had to go to trial during the pandemic, when they were they were saying that there was an evidence there that they were some sort of document, some sort of email that they were saying, hey, look, guys, we're selling these Alexa products, these Echo products below cost. We're losing money on every single one of these. We shouldn't do that. And they were saying, the government was saying, hey, look, you can sell your products at below cost, $30 for the $60 thing to consumers. And it's yeah, that's a lot of consumer surplus right there. How is that any sort of complaint.
It's funny if you circle back a century, what the anti-competitive lawsuits were, right? It was about Standard Oil just price gouging because they could, because they had the deal, sort of the cutthroat deals with the railroads.
Yeah.
Right. Now we're suing for the opposite. Their costs are so low, or the prices are so low, that something needs to be changed. It's like, it feels to me a bit like she felt like she needed to do this after having this stance prior to coming in to the FTC role.
Yeah, they lost a lot of lawsuits here, and it's not surprising because they seem to be stretching. Here's a good question, maybe getting off of the lawsuit. Thoughts on Amazon replacing UPS, USPS, and FedEx? I would say maybe not replacing them because they're not going to get 100% market share, but there's going to be two worlds. One, the vertical integration at Amazon, who again is consistently, we talked about it in another episode, driving down costs. They're making stuff cheaper. They're not doing surcharges on Q4 anymore this year. And there's going to be another world, which is the disparate parts, the Shopify type stores, which again, a lot of market share. And use UPS, use third-party payments, use third-party warehouses, blah, blah, blah. So I don't think they're going away, but Amazon is going to be a big thorn in their side from a price perspective. And all they've done is drive down costs across these things. And given UPS's new labor stuff, it's going to be very, very tough for them.
Yeah, I don't think they'll ever fully replace, but I think people should certainly expect that Amazon will eat a fair chunk of their market share over time.
Yeah, and their goal is to drive all of their transactions off of UPS, I would say.
Well, speaking of unsustainable business models, which you mentioned earlier, Wish was in the news, I guess, a little bit because an activist is officially urging liquidation of Wish. Now, I haven't done any research on Wish in a long time, but I remember the last time we looked at it, we thought there is no way.
Speaking of a short,
they were selling beats for like $12, fake beats, and we're like, okay, this platform's dead.
But Temu's got to kill Amazon.
Yeah, it feels like Wish 2.0. Not to be too dismissive of every competitive threat to Amazon, I think Temu is basically Wish 2.0. Does this news surprise you that it's probably in liquidation scenario?
Does not. I am going to give you a little bit of a trivia here. Don't look, no cheating. Over the last 5 years, which I think it's just all time because they went public in late 2020. What do you think Wish's, or as they're known, their actual name is Context Logic? What do you think their stock returns are?
Minus 99.
Correct. Minus 99.4. What's a stock that's down 99% that goes down 99.5%? Or that saying, right? A stock that goes down.
What's the difference between a stock down 90% and a stock down 95%?
Yeah, no, what's the difference? What's the difference between a stock that's down 99.5% and a stock that's down 99% is a 50% drawdown. So pretty bleak stuff for them. And I think that was another example of one that would fit that upslope capital short candidate, right?
Well, maybe not now in the liquidation scenario, but yeah, it certainly would have. But obviously that's with hindsight. What did you think about the Target closing stores around theft concerns?
Another bullish thesis on Amazon this week. Everything's coming up Amazon.
It's a lot harder to steal stuff from a distribution center.
Yeah, exactly. That, unsurprising. I think a lot of these stores, people talk about the shrink there, which again, shrink equals theft. And yeah, that's probably true.
Like, and damaged goods.
And damaged goods. Yeah, Seattle, Portland, San Francisco, makes sense, right? But I think another thing that people may not be factoring in is that these places have been a bit hollowed out from a demand perspective, from office vacancies, from people living in these areas, right? And that definitely hurts demand for these companies who have big real estate footprints there. So it's not surprising that I would say these places get out of downtowns and go to the suburbs.
Yeah. I did read some just really discouraging stats around shrink, just growing. It's like 1.6% of revenue.
Oh yeah,
Shrink accounts. Like that is a huge cut into their margins.
I think it's almost 100 billion a year across the United States. That could be the world, but it could be the United States as well.
Yeah. I mean, it would be so discouraging as like a potential retailer going into like a big city. You're taking a lot of risk. You're putting your employees at risk, or at least some of these cities that we've referenced here.
What
that
do
are
you
referenced in the article?
Yeah, so we're at about 10:30 here, and I want to have a closing question here. How we had some I don't know if it wasn't a rant, but I say it was maybe a passionate discussion on how this FTC stuff doesn't really make sense against Amazon. I'd say one, from an investing perspective, it really doesn't matter. Like the legal fees are going to be irrelevant, blah, blah, blah. Are you worried that we're going to have some cold takes here, some evidence comes out that Amazon is doing a little bit worse things than we think? How are you thinking about that maybe as we close out?
I really doubt it. I mean, I'm sure there's been some malpractice at some spot in the company, but from like a strategic perspective, don't you think margins would be higher if they were really optimizing to destroy their retailers?
That's true. Yeah. Do you think there's going to be an email that comes out that says we need to put these blank, blank, blank out of business so we can then raise prices? I don't know. There
really
could be, though.
doubt it.
Here's the thing, though, that all the best evidence in these trials, they save, because it kind of adds up right till the end. They wait to bring out their best evidence kind of in a blow for blow.
Also, Amazon's been under pressure for a long time. I think the company knows to avoid saying certain things.
Right. It's been since 2017, right?
Yeah, I would be very surprised. Like, maybe someone sent a stupid email a long time ago, but I think they're all on guard to not say something dumb that could be pulled up in a trial. There's going to be that one employee that's like scratching his head, like, oh my God, what did I say?
Yeah, no, it's like he sends an email and then the first response is, hey, keep it in the Telegram, keep it in the WhatsApp. Okay. We talked about this.
Give me a call.
Yeah.
What did the CEO of Binance say? He's like, don't put any of our stuff in email.
Oh yeah. There's been some great stuff.
Sounds like something that's not going to be suspicious.
Yeah, there's been some great stuff on crypto lately, which I wish we could talk about, but that's usually a more of a boring topic. And
plus we got some hate from it.
That's true. Although I would say that the I think every week we're getting proven more and more right, but who knows? TBD. No one likes talking about it anymore. And I think that's evidence. That's kind of the evidence we need. But we're running long. That's going to do it for this episode. Thank you, everyone, for tuning in. Really had some good comments out there. And again, we go live Thursday mornings, but you can listen to the replays wherever you get your podcasts, YouTube, Spotify, Apple. Just search Chit Chat Money. Follow us there. As a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you, everyone, for tuning in, and we'll see you next time.